All right, well, let's continue to dig into the latest inflation report with Sam Stovall, CFRA Chief Investment Strategist, along with Zachary Griffiths, CreditSights Senior Strategist. So first, I want to start with you, Zach. I mean, in terms of the biggest contributors here, gasoline. So what does this mean in terms of the whole picture when you have one aspect of it really dominating the picture?
Yeah, when you look at the headline, the big move in energy prices was widely expected, as you saw with the AAA data showing almost a 10% decline in December. So that's important, but perhaps not sustainable. And so I think the move lower in headline CPI is encouraging. I think even more encouraging than the move in energy prices is the drop in food prices, or at least the deceleration in food prices that we've seen for several months now. So this is very encouraging for the US consumer and something that we think is going to continue throughout this year. And so falling input costs generally for companies is a positive for, I think you could say, equities broadly. And we have an overweight investment grade credit call. And so I think these kind of improving input cost pressures can help margins as long as the economy can remain buoyant in 2023 as we expect.
So then, Sam, as we look at the market reaction there, what are your takeaways?
Well, Rachelle, I think there are two takeaways. First off, it's a good example of buy on the rumors, sell on the news. We were expecting there to be a decline to 6.5% on the headline CPI from 7.1, and pretty much we got that. You could also say that the Wall Street was expecting more because we had 2 consecutive months of downside surprises, and today's report merely tracked current market assumptions. So I think it's a combination of investors expecting a little bit more, but at the same time being content with what they got and selling on the news after buying up in anticipation of a favorable report.
And Zachary, we know that the Fed is obviously tracking this when you look at things like core CPI. Does this weaken the case for them to continue their aggressive path? And what does that actually mean as to what that path will look like? Is it definitely going to be 25 basis point hikes from this point?
Well, the market is almost priced for a 25 basis point hike. It had been closer to 30 to 35 basis points over the past couple of weeks. So we think today's report affirms a view that we've held for several months now, that we are downshifting to 25 basis points in February. And when you look at the core goods side, you saw another decline. I think the third consecutive month there was a little bit, it was less of a decline this month than the prior two as apparel costs ticked up a bit. But I think the trend there is in place. We have goods disinflation, and we expect to see shelter costs in particular downshift in the second half of this year. So we think that's something the Fed is aware of and taking into account as it sets policy over the next couple of months. You're seeing part of the economy downshift from an inflation perspective, while there is some clear signs that there's more to come in the pipeline.
And Sam, where do you think the Fed goes from here, especially given that we did have that stronger than expected jobs data as well?
Well, I think that we're going to get the hike at the January-February meeting, but also possibly another hike of 25 basis points in March. But then we think the Fed hits the pause button. And if history serves correctly this time, we've normally seen the Fed start to cut interest rates fewer than 9 months after their last rate hike. So that would put it in December of 2023, which I think would cause investors to start to look across the valley and feel fairly optimistic that much of the worst is behind us.
And Zach, do you agree? Is that the sort of same timeline that you have for when we might see the Fed pause?
So we think the pause is actually in February. So just one more 25 basis point rate hike, and then pause through the remainder of 2023. So we don't think you're going to get a rate cut this year, but it could be on the table next year, especially if inflation falls the way we expect. We'd have the Fed really cutting back toward a more neutral policy rate from a very restrictive policy rate. And I think the biggest mispricing is the Fed very quickly shifting to rate cuts. The market is priced for a terminal rate of around 4.9% in June, and then immediately cutting after that around 50 basis points by the end of the year. We think that's the biggest mispricing. So we look for a lower terminal rate, but a longer pause at that terminal rate throughout 2023.
And Sam, as people look at their portfolios and wonder what to do next, I mean, JP Morgan predicting that equities will still offer lower returns than bonds, at least for now, so they're not jumping in. What's your take on in terms of the timing of equities and whether now is a good time to jump in?
Well, again, I look to history and I get a good sense that following down years in the market, instead of rising a little less than 10% on average, the market has gained 14%. And if you look to some of the indicators popularized by the Stock Traders Almanac that give an early warning signal for the full year, by that I mean the Santa Claus rally and the first 5 trading days of January, following negative years and those two positive indicators, the market has been up an average of 21.5% and higher 92% of the time. So I feel encouraged that we could end up being surprised by the market. And that's why we have a year-end target of 45.75 on the S&P 500.
Definitely on the more bullish side. We like to end on an optimistic note. A big thank you there. Sam Stovall there, CFRA Chief Investment Strategist, and Zachary Griffiths, CreditSights Senior Strategist. Thank you both for joining me this morning.